You are listening to the CMQ Investing Podcast. My name is Chris Franco. If you're new here, please make sure you're following on Apple Podcasts or Spotify, and that way you'll get all the latest episodes as soon as they're released. And in this episode, we're talking about Alibaba, which I just bought even more of during yesterday's massive dip. Tomorrow we have the earnings for Alibaba, which are expected to be, well, depending on who you talk to, but a lot of people are nervous about them. I want to read to you from this article that just came out. It's titled, Alibaba's quarterly profit is set to plummet 60%. Here's why. This article was written by Jack Denton for Barron's, and it goes like this. Alibaba's quarterly profit is expected to fall almost 60% year over year when the Chinese tech giant reports earnings on Thursday. Investors shouldn't worry too much. It's not as bad as it might seem on the surface. Alibaba is expected to report net income of $5.1 billion for the final 3 months of 2021, based on the estimates of analysts surveyed by FactSet. Profit in that range would compare to $12.3 billion reaped by the e-commerce and cloud computing powerhouse in the same quarter in the year prior, making a fall of more than 58%. Oh, it's not 60%, so I guess they're lying.
You lied to me.
It can be explained. The decline in profit looks less bad using Alibaba's preferred adjusted metric, which is also the earnings figure most closely watched by analysts. Alibaba is expected to report earnings before interest, taxes, depreciation, and amortization, aka EBITDA, of $8.1 billion for the quarter, which would be only 23% less than the EBITDA of $10.6 billion at the end of 2020. Still, that's a hefty drop. What's behind it? According to Danny Law, who's an analyst at a company that I can't even pronounce, but apparently it's one of China's biggest investment banks, he says that it is the consequence of slowing revenue growth and accelerating spending. So just keep that in mind about the accelerating spending, because that's one of the reasons I'm bullish on the long term. Law and his team see most Chinese companies facing a slowdown to their top line or revenue for 4 key reasons. The first is a weak macroeconomic outlook in China. Both government and private sector data indicate that Chinese consumers have had a tough time with retail sales and online consumption slowing into the end of 2021. China's economy and restrictions linked to the Omicron surge of COVID-19 cases share the blame. The second is a highly competitive environment as the sector faces anti-monopoly regulations. The Chinese tech sector was battered in 2021 from a regulatory crackdown by Beijing, which helped Alibaba lose almost 50% of its market value last year. Analysts tend to believe the worst is over, though the past week has brought some signs that regulators continue to keep a watchful eye on developments in the sector generally and on Alibaba and its affiliates in particular. The third reason cited by Law are decisions by Alibaba and others in e-commerce to waive fees for merchants to increase retention on their platforms. This would represent a strategic choice to pinch short-term revenue in favor of long-term or longer-term stability. Interesting. The fourth factor, remember there's only 4, the fourth factor behind what looks like on the surface to be a stunning fall in profit is due to what is known as the base effect. Ooh, the base effect. And by the way, that's B-A-S-E, not B-A-S-S, so for all of my music fans out there. Year-over-year growth is closely watched by investors when companies report earnings, but this number can be distorted when the year being compared to is abnormal. And 2021 was abnormal. E-commerce groups in particular boomed as millions of people housebound by the COVID-19 pandemic shopped online. While Alibaba's earnings at the end of 2021 are likely to be sharply lower than in 2020, it should still have been one of its most profitable quarters ever. These 4 factors identified by Law form a core part of why Alibaba is likely to report lower sales for its most recent quarter. Less revenue tends to also mean less profits, but there are other factors dragging on earnings themselves. In this case, higher spending is likely to dig into the bottom line. It's not a bad thing. We think it's responsible for China's tech sector to increase spending in research and development, sales and marketing, and admin expenses, edging up their competitive advantages, Law said. It should be the new normal under the anti-monopoly practices. So what he's saying there is if companies in China and the tech sector are now, basically under a certain scrutiny where they can't do these anti-competitive things, then naturally a sign of that working, a sign of this, policy actually stopping that from happening would be an increased capital expenditures because they have to spend to compete long term. So it's a good sign. That is if you believe that Alibaba can compete and win. The article continues here that Alibaba began to show flagging revenue growth when it last reported earnings. Profits were also sharply lower year over year in the last quarter. The picture, fundamentally, hasn't changed much, but that doesn't mean the stock won't be volatile on Thursday. Earnings surprises of more than 10% above or below analyst expectations for Alibaba's performance are not unusual. However, earnings in the last 4 December quarters have been, on average, 4.25% higher than analyst estimates. Alibaba shareholders have been taken on a wild and mostly ugly ride over the past year. If anything can be expected from the reaction to earnings, it's more of the same volatility. So here's what I take away from this. Expect some serious volatility tomorrow. If you're, an Alibaba shareholder, you might see a big drop tomorrow, regardless of what the news is. But at the core of this business and the long-term future, it's really solid. And when you actually dig into the reasons for, as in this case, a 60% drop in quarterly profit, you realize that it's not that this company's falling off. It's doing things that you'd expect any company that plans to be around for a long time to do. I also, in this, was something I didn't have in my head before I read this article, but that point about just how, COVID-19, I feel like COVID-19's in the past and like everything is based on this new reality. But the fact is that drop is, obviously intensified or enhanced, or at least it feels like it's bigger because it was such an unprecedented year when everybody was stuck inside. And I believe in China, where Alibaba has the majority of its sales, the restrictions were even more extreme, which would make the dependency or the need for e-commerce to be even greater. Anyway, so pretty interesting there. Here's some noise behind me. I think that's just New York City. That's nice. Sounds like someone's doing construction. Great timing. Let me see what else. There's a couple other things here. This is from a site I don't know. It's a Nikkei Asia. And it reads that Alibaba to report quarterly results as weak online sales bite. Hong Kong. China's Alibaba Group holding is set to report its latest quarterly earnings this week as the embattled company grapples with heated competition, a regulatory crackdown, and sluggish growth in its domestic e-commerce operations. Its U.S.-listed shares have lost more than half their value in the past year, and analysts warned that the slide may continue. Those dire predictions followed media reports Tuesday that Chinese authorities told state-owned companies to launch fresh checks on their financial exposure and other links to Alibaba's financial affiliate, Ant Group. The struggling unit, which declined to comment on the reports, was forced to call off what was then to be the world's biggest IPO in late 2020, as it was pushed into restructuring. The latest news will likely raise concerns that the companies could be in for even more scrutiny as China presses ahead with a crackdown on its tech sector. Meanwhile, competition from rivals, including JD.com and Pinduoduo, which I know I said that wrong, is mounting. A question here, I'm just going to answer this. There's a question in the comments here. Why are you focusing on quarterly results? We're focused on it just because tomorrow are Alibaba's quarterly results. We've been going big on Alibaba, and it's interesting to understand the nuances, or rather what's below the surface of the results. I think there's always more to learn about this company. We're, at least CMQ investors anyway, we're long-term investors. So, I'm not buying or selling based on tomorrow's reports, but it's definitely something that's going to be on my radar, and I want to see how the market responds to it. And it's interesting to, continue to build this pattern recognition for what makes the market move, for up or down for a particular company. Because there's a lot of emotion at play with Alibaba. So as I continue here, on Thursday, Alibaba reports earnings for its fiscal third quarter, which has traditionally been its best performing period. But the e-commerce giant's management has already warned its results could suffer over the next several quarters. Alibaba's revenue is expected to grow at its slowest pace on record for the year ending March 2020 by between 20 and 23%. By the way, that's not horrible when you consider, I think their revenue is, $200 billion? It's not terrible. We only grew 20%. In the July to September quarter, Alibaba's revenue rose 29% to 200.69 billion. And that's, by the way, that's in yuan, which is the currency. I'm sound so ignorant, but that's the equivalent of 31.7 billion. While its net income plunged 87%. And the reason for that, the company cited investments in key strategic areas for the fall. And we've talked about this in the past. They're aggressively investing in their cloud unit. They've doubled their capital expenditures, at least they did last year, on all things cloud computing. Alibaba's key domestic e-commerce unit, which accounts for about 63% of its total revenue, was expected to take a hit owing to slower online consumer spending on food, clothing, and cosmetics. The segment last year grew at its slowest pace since 2015. Online retail suffered another blow when live streaming queen Via and Zhu Shenhua, who together contribute about 8.8% of Alibaba-owned Taobao's real-time sales revenue, vanished from the platform after being slapped with record fines for tax evasion late last year. Man. In an effort to boost its domestic retail business, Alibaba reshuffled its top management, with Trudy Dai, who's one of the company's 18 founding members, taking charge of a new China digital commerce team in January, essentially replacing Jiang Fan as head of the domestic e-commerce unit. Jiang will instead lead the international digital commerce team. Meanwhile, Beijing's regulatory crackdown is spreading to Alibaba Cloud, heaping pressure on a unit that has drawn heavy investment by the company and reported 33% on-year revenue growth for the latest quarter ended September. Last year, the northern Chinese city Tianjin, which, by the way, guys, all these names, I know I'm butchering them. I feel talk about change the name of the podcast to The Ignorant American Reads the News. So I apologize to all of you who know how to say these names. All right, so last year, the northern Chinese city Tianjin asked state-backed companies to move their data from private sector operators like Alibaba and Tencent to a government-backed cloud system. Similar moves by others could make Alibaba Cloud worth $0, according to Lightstream research analyst, some guy who I'm not going to give his name a mention because I can't say it. ELE.me, an online food delivery platform acquired by Alibaba in 2018, is also under mounting pressure from regulators as China's top economic planner called for online food delivery platforms to cut the fees they charge restaurants to help the pandemic hit service sector. The guidance sent food delivery groups Meituan's Hong Kong listed shares tumbling by more than 14% on Friday. But despite these headwinds, analysts say that Alibaba has already finished its decline and predicted the stock could bounce 68% by March next year. This month, Alibaba filed to register an additional 1 billion American depository shares, which Citigroup analysts said suggests a potential selling intention by top shareholder SoftBank Group. The Japanese tech investor holds a 24.8% stake in Alibaba, but SoftBank has said there was no link between Alibaba registering the U.S. share facility and any plans to sell down its stake in the company. Interesting. I got to start reading more just like business sites that are based in Asia. Because I learned something there that I didn't know about, which is great. That's what we want to do here. Yeah, this is I'm at asia.nikkei.com. Interesting. So I'm looking forward. I bought more Alibaba yesterday. For those of you who care, I should send out an email with my latest portfolio moves. I bought some Google. I bought some more Costco. I didn't add any new positions. I just added to existing. Again, I'm long term, so I'm not trying to do anything too smart. But I had some cash on the sidelines, and I figured, you know what? What else are you going to do with it? But my portfolio has been taking a total beating, as I know most people's has, in recent weeks. So we just got to stay the course here, guys. Yeah, that's a great point. It's a homegrown Chinese rags to riches story. CCP wouldn't want to get rid of something so rare. That's exactly something I've been saying, and I think that's nice to hear someone else say it, obviously, because it's confirmation for me. But I just don't see in terms of what a country, the incentives of a country, right? You'd want to have your big companies be big on the world stage. Like, you'd be proud of that, right? So if you have a company that can do that, I understand that there needs to be some regulation to stop anti-competitive practices, and I totally support that. That doesn't bother me. I want to see the companies I own pieces of be responsible and ethical and do things in a way that I can feel like they're, I can support what they do, and I don't feel like I'm, invested in a cheater. But when you break it down, once that's out of the way, why would the Chinese government not want this company to do well? Because at the end of the day, yes, it is a communist country, but free market capitalism has created a lot of prosperity. Prosperity has been very good for China. So, think about the money that Alibaba, basically what Alibaba does for a tax purpose, from taxes, from, how it helps small businesses. It doesn't seem like, unless there's a precedent of the CCP just like taking over businesses, which, if someone knows about that, tell me. I get that the unknown factor is China's government, but I take this approach, and I've talked about this before, so not to repeat myself, but I do think that there's the likelihood of some of these extreme outcomes happening is, to me, it's a low risk. Where like the Chinese government's just like, we're taking this over. I think there might be, some threats in the short term, but long term, would you just put yourself in the perspective of a world government? Would you want your best companies, your companies that could become the global behemoths? Would you want to hold them back? Okay, I'm just looking at my portfolio for the year to date. So I'm beating the S&P. Well, actually, I'm about even. I'm beating the Dow Jones, but everything's down year to date. So I have to keep reminding myself that it's really easy to look at the portfolio and be like, have I just totally messed up everything I'm doing? Another question is, what would happen that would make you sell, right? Like that's something that's kind of interesting. But anyway, remember, fundamentals always win in the end. So we'll have to see how Alibaba looks tomorrow. Thank you for listening to the CMQ Investing podcast. My name is Chris Franco. There are new episodes uploaded every week, so make sure you're following on Apple Podcasts or Spotify. If you enjoyed the content, please make sure to leave a 5-star rating. And if you're listening on Apple Podcasts, a written review goes a very long way. Thank you to all of you for continuing to support all things CMQ Investing. Our goal is to make this content better and better for you, so it serves you, our listener, and our community. With all that said, once again, my name is Chris Franco. Thank you for listening. We'll talk soon.